Now we have Mr. Steven Saretsky.
Yeah, for sure. I mean, I can't speak, too specifically on the tourist sector, tourism segment. Obviously, you guys are still, facing with different variants and lockdowns and whatnot, and restrictions. So that's certainly impacting the travel sector. I mean, what I can speak to is I'm very, very active in the real estate space. So I'm speaking with people in the real estate space on a daily basis, tons of Canadians. That's kind of where I'd probably focus my attention. But I think that we're dealing with certainly, I think, some of the ramifications of the spending that's coming through. There's always knock-on effects, and I just think that we have to be cognizant of those knock-on effects, which I think that certainly we're seeing that showing up in the housing sector. National home prices running at 23% year over year, back to back. So in 2020, we had record home sales. In 2021, we're going to have another year of record home sales. And so I think that what we're seeing is some of these sort of excesses are sort of sloshing around. So I think it's important to, obviously the bill I think is certainly needed in the aspect that there are sectors or segments of the economy that need help, like the transportation and hospitality. But I think, like I said, I think it's just dialing in those flows and making sure that we're not overcompensating. I would say this is my only real commentary, because I think that overcompensation, I think, is showing up in asset prices, and particularly in the housing market. And I think that there's a lot of, I think there's certainly, I think it's a crisis. I think it's a crisis right now in that segment. So that's kind of where I'd focus. I don't know if anyone has any particular questions on that aspect, but I'm certainly happy to comment on that further.
I'll move to Mr. Saretsky now. Mr. Saretsky, you talked about the overcompensation of real estate markets based on the government's stimulus measures. Can you extrapolate a little bit on that, please, and expand on what you mean and how much that's caused the overvaluation of real estate, the overpricing of real estate in Canada?
Yeah, I mean, obviously, when you go through, typically recessions, right? I mean, I think at the onset of the pandemic, everyone's talking Great Depression, which is certainly nobody wants that. What ended up happening was, it was certainly rushed out the door, and probably rightfully so. But in the second quarter of 2020, labor income declined by about 20 billion nationally. But at the same time, government transfers to households grew by over 70 billion, right? So we basically, there's $3 that went out the door for every $1 lost in income. And so what happens is you have a situation where, typically, again, in a recession, for example, you'd see that decline in consumer demand, but that was kind of offset by government transfers, while businesses reacted by obviously shutting the doors, thinking the worst was coming. And so what you have is basically too much demand out there, because it was supported by government households. And again, I'm not saying that's the wrong decision to make, but it's just it's now we're starting to see that obviously in consumer price inflation, consumer price inflation expectations right now in Canada are running at a 20-year high, and businesses are expecting. Half of businesses next year are expecting to raise prices by 5%.
Sorry, Mr. Saretsky, I'm running out of time here, but your expertise is in real estate. So the inflation caused in real estate assets has been quite severe. What would you say if there's an extra $9 billion coming into the system? Would that inflate prices even further?
I mean, I think it definitely has the potential, right? I mean, I think for every action, there's a reaction. I think that we're seeing is the bulk of the credit creation is going into the housing market. You can see that consumer loan growth, residential mortgage loan growth is running at decade highs, 10-year highs.
Now, since we heard that Canada's real estate has gone up so much, the Canadian public is basically all but expected at this point, although not the best practice, to remortgage their homes and use that equity to pay for food, gas, and utilities in an already unaffordable Canada due to inflation and liberal mismanagement. But to turn around and give the businesses money to pay their bills, I'm questioning why can't the business take the equity out of their buildings and pay the bills like the rest of Canada has to do in this climate?
I mean, I can't speak too specifically on the businesses, but I think if you look at where the banks are lending money, where the credit growth is, it's all in the residential mortgage space. So like I said, residential mortgage credit growth is running at 10-year highs, and that's obviously inflating house prices. And if you look at business credit growth, it's basically stagnant. So I think that maybe the banks are looking at it and saying there's risk there in terms of refinancing a business for them to then go out and spend on CapEx, for example, right? So I think it's probably just a risk thing for the banks.
Mr. Saretsky, you work in real estate. The CMHC, the largest and most powerful government housing agency in the country, predicted that COVID would bring a 10 to 14% drop in housing prices, and it made sense. No immigration, wages dropped, people were frightened, they didn't know what their future was, and they're not even allowed to go and visit the houses that they're considering purchasing. But yet, after a brief drop, housing prices actually rocketed up a third since COVID began. To what do you attribute that sudden explosion of house prices that began in spring 2020 and continues to this day?
Yeah, I mean, it's a good question. I mean, I think first off, part of it is certainly psychological, in the fact that, people working from home is obviously a greater demand to increase your living space. But I think the other thing is we have to look at is ultimately, in order to make that purchase, you need money and you need access to credit. And I think what happened was, as much as government was trying to help, I think there was an argument to be made that we perhaps overstimulated, and that overstimulation is showing up in house prices. So, like I said, if you look at, money supply growth, it's up 20%. You look at residential mortgage credit growth, that's where the banks have been lending their money. And obviously today, I mean, you can still pick up a variable rate mortgage at 1.3%, with inflation now running, north of 5%, or basically at 5%. So, you're looking at a real mortgage rate of, negative 3%. And that's very compelling, to purchase hard assets such as real estate. And we're seeing obviously a growing investor base, which obviously the Bank of Canada has flagged more recently as well. So
I find it ironic that the Bank of Canada has flagged these investors as the culprits when, since the Bank of Canada began its quantitative easing program, mortgage lending to investors is up 100%, according to the Bank of Canada. So it's the money that the central bank is creating that these investors are using to make their investments. Do you find that ironic?
Yeah, I mean, I think that, like I said, I think for every action there is a reaction, and I think that maybe it was well-intentioned, but like I said, I think that the knock-on effects are certainly higher asset prices, and I know that we're now wondering why all these investors are active in the market. I mean, I can tell you, at least in terms of my clientele, we just look at it and say, okay, well, look at all the money going out the door. This is typically, historically speaking, very good for hard assets, such as real estate, and that's certainly drawing more and more Canadians into the housing market. And, we're seeing, typically one of the big trends that we're seeing right now is normally what you do is you have a condo, for example, and you sell it and you upsize into a house. And so you'd sell one asset to buy the other asset. What we're seeing now, and very common, is people will keep that existing rental, that condo, they'll convert it into, a rental property, they'll refinance it, and then they'll go out and buy their house. So they're opting to keep multiple properties. And I think that's a result of, the bull market that we've been in Canadian housing. I mean, home prices growing at 20+%. I mean, where else would you put your capital? And so again, there's certainly some.
It really is, and it's, you mentioned that people want more space, but even condos are up by 15% in inner cities, so those prices are up as well. You point out that the wealth just keeps rolling over and over. The super rich, what they do is that they watch their asset price inflate, and then they borrow against that asset to buy another asset, which then inflates, and then they borrow against those assets to buy more, and it just multiplies and multiplies. They consume more and more of the available housing stock, and the real value of their debt goes down because inflation reduces its real worth. So this inflationary economy is wonderful for the ultra-rich investor class, even if it is terrible for working class renters. Would you agree with that, Mr.
Thank
Saretsky?
you.
I would say so,
Thank you.
Mr. Saretsky, I think we appreciate your expertise on the real estate sector. We've spent a lot of time talking about affordable housing in the last few days, and we had some time with the Minister of Finance earlier this morning. We've tried a lot of things to deal with affordability crisis. I think you're in the West Coast, vacant homes tax, a speculation tax, banning foreign buyers. But some of the underlying fundamentals of the lending market have remained consistent, and that is low interest rates. In your opinion, what is it going to take that's going to affect the housing market most specifically, and what are the risks that are growing in that market by the current structure?
Yeah, I mean, it's a good question. I think that so long as interest rates are where they're at and mortgage rates are where they're at, you're going to continue to have a larger and larger inflow of capital into that housing market. It's just what it is. So long as rates stay low, solutions I'm looking at and saying, okay, well, yeah, we've tried, I'm in Vancouver, right? So empty homes tax, we've tried a speculation tax, we've tried an Airbnb ban, we've tried everything. I think one of the biggest barriers, I would say, if you're not going to raise interest rates, then the biggest thing I can say that we can try to tackle is ultimately more housing supply. And the big challenge really is at the municipal level is the amount of red tape, the length it takes to get a project approved and get homes built is simply way too long.
Mr. Saretsky, can you give us an estimation of the percentage of properties that have been sold that are sold as investment properties now? A percentage, please.
I mean, I think it's hard to figure out what that percentage is. I mean, all I can say is I work in the inner city here of Vancouver, and 50% of that is investor-owned units. So,
50%?
50% in the inner city. If you're talking about condos, I think it's close to that number. Yeah.
Thank you.
Downtown Vancouver, I think is 60% renters.
Okay, thank you very much. Give us some perspective on why you think Canada's housing prices have increased at a level so much higher than the U.S. has increased.
I think really a huge thing is one, we haven't been building enough. Number two is we certainly have, a lot of immigration in our country. And number three, I think the bank lending is a big thing. I think that there's been a lot of credit growth. And if you look at, all you have to do is look at household indebtedness in Canada, right? So that basically tells me that people are taking on a lot of debt. And that most of that debt is in the form of mortgages. So the banks are obviously lending.
Yeah. Okay. Thank you. So it's low interest rates that are causing a lot of this. These low interest rates are non-market mechanisms right now because of the Bank of Canada's policies of keeping interest rates low with quantitative easing. What would happen once we return to a market mechanism for setting interest rates if those mortgage interest payments increase, as they surely will? What will happen to both the payments that are due from the home buyers plus the actual ownership of those units? Will they switch over to investors even more?
Yeah, you'll have a substantial repricing in home prices. So if mortgage rates rise, I need to remind people sometimes that in 2018, mortgage rates in Canada hit 3.5%. Everybody thought they were going to go to 4%. During that year in 2018, Greater Vancouver home sales dropped to an 18-year low, and in Greater Toronto area, they dropped to a decade low. And so if we get any sort of repricing in the mortgage market, what you will see is you'll see a repricing in home prices. So for example, in 2018, Vancouver home prices dropped about 10% as a result. And then same time, what you will see is you'll see more investors, I think, hitting the sell button. For sure, you will see that, and that will obviously add to supply on market and probably weigh on prices as well.
Thank you very much.